Welcome, and thank you for joining us today. I am Mark Baumel, Senior Product Strategist with Securian Asset Management, and I am joined by my colleague Sean O'Connell, Head of Real Estate and Alternatives. As a firm, we have over 40 years of experience in the commercial mortgage loan space. 4 years ago, we launched our first program for clients to participate individually. We are now launching a program for clients to participate within a group and to be able to do so at a lower commitment level. We will go through the details of that program today. In this webinar, we will cover Securian Asset Management's experience in commercial mortgage loans, including our platform, approach, and process. We will go through the benefits of participating in either of our programs, including enhanced yield and diversification by both geography and property type, and then get into the features and benefits of our new multiple client loan group program, and then we'll close with a Q&A. Now I will introduce our presenter and then hand it over. As Senior Vice President and Head of Real Estate and Alternatives, Sean oversees all of our commercial real estate holdings. Sean joined Securian Asset Management in 1993 after receiving a BS in Agricultural Economics and an MS in Real Estate Appraisal and Investment Analysis from the University of Wisconsin-Madison. He has previously led a team responsible for structured finance and also oversaw the trading desk. Sean is a CFA charter holder and a member of the CFA Society of Minnesota. And with that, I'll turn it over to Sean.
Good morning. Our firm has a long history investing in U.S. commercial real estate, and while we are here today to discuss our direct lending platform, we believe our larger platform in CMBS and the REIT debt and equity sectors gives us a unique view into the market and can assist us as we underwrite new loans. A quick example, we were evaluating a unique office opportunity in Cambridge, Massachusetts, just west of Boston. We like a lot of the attributes of the transaction, but we were having difficulty making sense of the purchase price our borrower's paying. We were able to tap into our REIT equity team, and with a few phone calls, we're able to access an analyst database of all of Boston Properties buildings, Boston Properties being one of the largest office owners on the East Coast. That database included valuations and replacement cost estimates of every asset that Boston Properties owned. We were able to identify like-kind buildings to the one we were looking at to finance. It gave us another data point in our underwriting, and it led us to continue with the transaction. A little bit about our experience. I'm blessed to lead a team of 7 senior lending professionals averaging over 20 years of experience in the market. They all have workout experience, which is very important when you're doing front-end evaluation of new loan opportunity. If you can see what can go bad, you can better able to manage around those potential issues with upfront structuring. They all have dedicated markets in the U.S. that they cover extensively. In addition, we complement that experienced team on the business side with an in-house legal team specializing in commercial real estate. Additionally, we have a specialized in-house closing and servicing team that runs from the analyst's approval to closing the transaction and then the ongoing monitoring and servicing of the loans going forward. As I mentioned earlier, we have a lot of experience in the space, 40 plus years in our direct lending operation, along with 20 plus years in various sectors of the commercial real estate market. We're process-driven in our loan origination platform. We source transactions through a brokerage model that's a correspondent network of brokers around the country, many of which we've had relationships 15 plus years. We also compete on price and structure, not proceeds. We're not the high leverage lender in the space. And as such, we target a long-term investor as our borrowers. Our lending approach really focuses on diversity, and diversity by geographic location and property type. The map here shows our exposure across the country and where we're active as a lender. The seasoned team here with experience over multiple market cycles informs us on where we should be putting our dollars, and also To the extent that we have overweight or underweight, we need to manage through that. And then we have an ongoing, as I mentioned, servicing and loan management system. Some people ask, well, why the diversification? Why is that so important? Well, as an example, in the 80s, people thought they were diversified if they were in New Orleans, Houston, and Denver. But it turned out with the oil decline in the 80s, all of those markets were linked significantly to the oil industry. And commercial real estate owners and lenders took many losses. Similar, in the housing market meltdown in 08-09, there were markets that were very linked in the suburban office space to the housing market. And when the housing market fell apart, in kind, the suburban office market came under significant stress. A little bit about our process. We begin with the merits, the review of the merits of the loan, and to the extent that we like the transaction, we'll bid on it, and to the extent that we are the winning bid, we'll negotiate a term sheet. It's at that point our senior analyst will get on a plane and meet the ownership at the property level. We'll do a property tour, market tour. We'll also look at how we think the asset sits in the broader market. When they come back to St. Paul, they'll continue their underwriting. They'll draft the write-up, and it goes through a peer review. The peer review is very important. We have a lot of senior people with a lot of experience. We're looking for something that somebody may have missed. There's some input given at that point in time, and to the extent that the transaction has to be changed in any way, it occurs at that point. Due diligence and closing is the next phase in the origination process. We engage outside counsel. Phase 1 environmental is completed. A property condition report is made with a building engineer going out and actually looking at the asset, coming back with a list of any deficiencies and the dollars necessary to cure those deficiencies. To the extent that we feel necessary to hold back proceeds from our lending, we will, or we'll make changes to the loan itself, or we will not go forward with the loan. And then ongoing, we annually review all our financial metrics on the loans, and by property site inspections, we get a better feel for the property level condition and the ongoing leasing. We are also the approval of all leases going forward. So when I'm asked why we like this sector, I put my portfolio management hat on. We like the enhanced yield that this gives similar to BBB corporate spreads with an A corporate loss profile. We like the diversification, as I mentioned, geography and product type, but then when you complement it with our corporate exposure, it becomes a very diverse portfolio for the insurance company. We are the secured lender. We control a workout. There are no creditor committees. All decisions are made here in St. Paul. This slide evidences our view on the benefits of the asset class. The persistency of the spread pickup compared to A-rated corporates over the last almost 20 years really validates our view of the asset class. Finally, our loss experience in this space validates our extensive underwriting process. Over $7 billion today in loan origination, over 1,300 loans with only 10 loans having losses. And how is that possible? Well, I believe we have a talented and very experienced staff here in St. Paul, a disciplined process, and we don't cut corners. We originated 135 loans last year, and every one of them went through the process that I illustrated in the previous page. And now to introduce to you our multiple client loan group program. When we put this program together, we had four main principles in mind. One, we would participate alongside our clients. So we, Minnesota Life, wouldn't change our lending style or process. Two, we wanted to give our prospective clients, independent of bite size, an opportunity to participate. Third, we wanted to construct a group of loans which would provide diversification for our clients. And fourth, a repeatable model. So for those clients who wish to average in over rate and spread cycles, they can participate in multiple groups. A couple of highlights of the program structure. Minimum client subscription of 10 million. The loan group size is targeted to be 100 million, of which Minnesota Life will provide 20% of the dollars. Program parameters. So at the end of the pool, the end of the group being filled, the loan parameters will look as such. Loan sizes of 3 to 10 million. Why is this important? That should give us 15 to 20 loans inside the closed group to provide a lot of diversification. The initial NAIC quality rating will be CM1, CM2, which would be considered investment grade. It's very similar to the NAIC 1 and 2 corporate measurement. Property types originated are listed here. More importantly, what we will not originate, we originate loans that have historical cash flows. Land development by its nature does not, nor does vacant land banks. We also will not do any construction loans. We do not take construction risk. And then we'll have concentration constraints so that we will have a very diversified portfolio, both geography and by property type. And a little bit about our experience in this space. We have been a historical lender to borrowers that are requiring loans of 10 million or less. You can see our existing portfolio has 60% of those loans, $10 million or less. And then before we end, why Securian Asset Management in this space? Well, I think you've seen we have a very strong real estate market expertise across the real estate spectrum. Specifically to CML lending, we have a very experienced team with multiple market cycle experience and the benefit of a long-term relationship-driven correspondent system. We in-house service our loans here in St. Paul, and we benefit from the financial stability of being a unit under the Securian Financial Group umbrella. And with that, we'll close.
We'll leave the disclosures up for a second. Great. Thank you, Sean. If you have any additional questions, would like to receive a copy of today's presentation, or would like information on how to participate in either of our CML programs, please reach out to your contact at either AAM or Securian Asset Management. Thank you for joining us, and have a great rest of your day.